In this video, I'm going to show you the current assets versus non-current assets, capital versus revenue expenditure, recognition and measurement of assets, and then revaluation of those assets. So it's a lengthy question. It has got 4 parts, and the reason I'm calling it 4 parts is because I'm going to combine B and C together when answering this question. So the first part is distinguish between the current and the non-current assets. And current assets, first of all, assets are those which are owned and controlled by a company. And the difference between current and non-current is based on their life. If they are short life, means less than 12 months, means they will be expected to release within 12 months, then they are current assets. So the examples of current assets will be money in the bank account, because it is not going to stay at the same level. It will change on a weekly or monthly basis and yearly basis. Cash balance, which will also change. Receivables are also our current assets, and the balance of receivables will change. We will not have any receivables balance in our accounts which will stay for more than 12 months. We also have closing inventory, so which is also called closing stock, which will not stay the same over the more than 1 year. We will be selling it to our customers. And prepayments are also our current assets. Prepayments balance will not be in our books for more than 12 months. This is something which we have paid in advance, for example, rent, and we will utilize it over the number of months. And our prepayment balance never stays for more than 1 year time. Talking about non-current assets, these are those assets whose life is more than 12 months for it, and they will be in our business for more than 12 months time. For example, building, land, vehicles, fixture and fitting, fixture and fittings. It also includes patents and trademarks. So this is the distinguish between current and non-current assets, and they all appear in our statement of financial position, which is also called balance sheet. And if you remember the accounting equation, assets are equal to capital plus liabilities. So these are all our assets which will be appearing in the statement of financial position. Moving on to B, explain the capital and revenue expenditure. Now, I'm going to go through an example of capital and revenue expenditure, and in this example I'll explain what is the difference. So the basic understanding is capital expenditure is when we spend money on any asset, and that asset has been bought to generate income for the business or to enhance the income of the business. Now the example is, for example, I'll buy an aeroplane and it has got 50 seats, and this aeroplane is used for domestic travel and it can carry 50 passengers. I'll be buying this aeroplane in order to generate some revenue. I'll be selling tickets, I'll have passengers to carry, and I will take them from one city to another. And that is capital expenditure. So let's say I have spent £700,000 on buying this aircraft. Later I decided to increase the number of seats. I added 10 more seats. It's just an example. I'm just supposing I added 10 more seats, which will further enhance my inflow of cash. I will be able to sell 60 tickets now, and I will be able to carry 60 passengers. And because it is going to enhance my my cash flow, I will record it as a capital expenditure and it will become part of the asset. So let's say I have spent £50,000 on the value of the asset, on adding 10 extra seats. Then I decided to change the color of the aeroplane. Let's say it was white in color and I decided to have light blue color aeroplane. Now this is not going to enhance my income. It is not going to go faster, it is not going to carry more passengers. So any amount spent on the maintenance of the existing asset or keeping of the existing asset, which will not enhance my revenue, will be recorded as a revenue expenditure. Repainting. And I'm just entering any figure. Let's say I have spent £25,000. This will be recorded as an expense. So remember, all the expenses appear in our income statement, which is also called the profit and loss account, as an expense. Aircraft cost, which is an asset, this will be recorded as a non-current assets in my statement of financial position, which is also called the balance sheet, statement of financial position. Part C of the question is, if company incorrectly classified the item of capital expenditure as revenue. Now continuing with this example, if my accountant recorded 750,000, so income statement, he recorded expense of 750,000. Assuming that there was a gross profit of 500,000 already in my books, this means that he incorrectly recorded the capital expenditure as revenue expenditure, and my company is showing a loss of 250,000 now. So a profit has turned into a loss. On the other hand, in the statement of financial position, nothing has been recorded. Nothing has been recorded. So you can see that because of incorrect recording, the company is showing a loss. To further this example, let's say if the accountant recorded it correctly, if he would have recorded it correctly, then in the statement of financial position, we would have recorded non-current assets, aircraft, of £750,000, less the accumulated depreciation. Now I'm just making up this. Life of the asset is, let's say, 20 years. So a depreciation of 37,500 would have been recorded. In the income statement, the gross profit, which is 500,000, less depreciation charge of 37,500 would have been recorded, showing an overall profit of 462,500, and the carrying value of the asset would have been 712,500. This would have been a better, the correct situation of our financial statement, with a profit and a non-current assets with a carrying value of 712,000. So this is incorrect representation. So you can see that with just one mistake of the accountant, the whole figure, the whole picture of the financial statement has changed. Now, part A of this question is part D of the question. It says, in accordance with the rules of IAS 16, calculate the cost at which the machine bought by Alpha should initially be measured. Also explain the correct accounting treatment for any component of the £420,000 expenditure which cannot be treated as part of the machine cost. Looking at this example, Alpha bought a factory machine on 30th of June 2019 and paid a total cost of £420,000. This is the total money or the amount paid by Alpha for buying this machine. Alpha cannot capitalize the whole amount of £420,000 in his statement of financial position. Therefore, we need to identify which expenditures are not allowed. So 380,000 is the list price of the factory machine. The trade discount needs to be subtracted because IAS 16 requires any trade discount to be subtracted. So 342 is the reduced price. IAS 16 says that any delivery charges should be added into the value of the asset. IAS 16 also mentions that any installation costs should also be added into the cost of the asset. So far, by adding these three costs, our assets value is coming up to be $378,400. Now the remaining two expenditures, which are maintenance cost and the small spare parts. So this £27,000 is the maintenance charge which Alpha has paid for the whole year. You can see that the start of the year is 30th of June 2019. So I can say that it's 1st of July 2019. Remember that 30th of June 2019 is the last date of previous accounting period, and 1st of July 2019 is the start date of the new accounting period. So the 30th of June 2019 was the closing balance, and 1st of July is the opening balance. So 27,000 has been paid for the whole year up till 30th of June 2019, £27,000. In this question, the year end is 31st of December. So counting the months from July, 1st of July 2019, July, August, September, October, November and December, halfway through the period 31st of December, the accounts are closed. This shows that half of the cost of £27,000, which is 13,500, has been consumed by Alpha Limited, and the remaining £13,500 has not been consumed yet. The other way to understand this is the full year. The rent is £12,000. I have rented an apartment. I have paid £12,000 to rent an apartment. £1,000 is the rent for each month. This is from January until December. At the end of January, I would have consumed 1,000, and the remaining 11,000 is still prepaid. If I'll change my mind, I'll inform the landlord or the estate agent that I am no longer interested in this apartment. Can I have my £11,000 back? So any amount which I have paid in advance is my money, which I can reclaim. And that is why prepayments are recorded in current assets. So £1,000 is consumed and the £11,000 are still prepayment, which I can claim back. In this case, Alpha has consumed 13,500 and the remaining 13,500 is still prepaid, and Alpha can still use it. The other cost is the maintenance cost. Small spare parts. Usually these small minor expenditures are recorded as an expenditure in the financial statements. Sometimes companies prefer to record them as a current asset, but with the life of this asset is less than 1 year, and eventually it has to be recorded in the expenditure. So this small spare parts cost will be recorded as an expenditure. It is just like when we buy a car, the petrol in the car is recorded as an expense, even though it is essential for the car. You cannot operate that car, drive that car without petrol or diesel, but the cost of diesel and petrol will be recorded as an expense rather than as a value of the asset. So it is not capitalized. So now looking at these figures in my statement of financial position, I will be recording non-current asset. In my non-current asset, I will have a machine with a value of 378,400. In my income statement, I will be recording expenses. The £27,000, which is the maintenance charge, half of that is an expense. £13,500, and the other 13,500 will be recorded as a current asset in prepayment. Prepaid maintenance cost, which is 13,500. Spare parts will be recorded as an expense in the income statement. So this is the recognition and valuation of assets in our financial statement. The next part of this question is about Beta Limited. On 1st of January 2009, Beta Limited bought freehold property for £800,000. This figure was made up of land and building. 1st of January 2009, the asset was bought for and this is 800,000. This 800,000 is made up of land and building. And the value of land is £300,000. And the value of building is £500,000. The land is non-depreciable. It's always non-depreciable. Land has been there, the earth has been there for many years, and many years, and it will continue to be there, and we do not depreciate the land. But it was decided to depreciate the building on a straight line basis, and the life of the building is 40 years. Now remember, the life is 40 years. On 1st of January, the land was revalued at 400 and the building was revalued at 450,000 on 1st of January 2019. So we bought this property, freehold property, on 1st of January 2009. From 2009 until 31st of December 2018, which is one day before 1st of January, which is the new year, 2019. So 31st of December 2018, we will have the closing balance, which will become the opening balance for 1st of January 2019. Counting the number of years, January 2009, whole of 2009, whole of 2010, 11, 12, 13, 14, 15, 16, 17, 18. So there are 10 years. 10 years. That means this asset has been depreciated. The building has been depreciated over for 10 years. Now let's work out the depreciation charge. 500,000 divided by the life, which is 40 years, multiplied by 10 years. And this is £125,000. That means the building value has been depreciated for 10 years. The life is 40 years, but we are calculating the first 10 years because after first 10 years, in the 11th year, the value of the assets will increase, and then we will have to work out the new depreciation charge, and I'll show you in a second. So in my statement of financial position, for the first 10 years, non-current asset land will be valued at 300,000, and the building, which is 500,000, will take away 125,000. 375,000. For the 10 years. And in the income statement, we will have to show the depreciation charge for that period only in the 10th year. This is accumulated depreciation. Accumulated depreciation means depreciation of this year plus the previous 9 years. Altogether, it's 125. But the depreciation charge for current year is 12,500. How did I get that? It's 50,000 divided by 40. 500,000 divided by 40 years, it's 12,500. So the depreciation charge for each year is £12,500. So over the number of 10 years, the accumulated balance is 125,000. But in my income statement, I have to show the depreciation charge for this year, which is 2018. £12,500. Now we are told in this question that on 1st of January 2019, the value of the land has been revalued and the new value is 400,000. This 300,000 value in our books is still there, and the new value is 400,000 for land. And therefore we can see that the increase in the value of the asset, which is called the revaluation, is £100,000. The value of my land has gone up by £100,000 over 10 years' time. The value of my building, which was 375, I'll write it down over here. £500,000 take away £125,000 is £375,000. This £375,000 carrying value has been increased, and the new value of the building in 2019, 1st of January 2019, is £450,000. So if we compare it with the carrying value of 375, it has gone up to 450. So there is an increase of £75,000. £75,000. Bear in mind that if I compare this 450 with the original value of the building, which was 500, it is still lower. Compared to the carrying value, it has gone up, but it is still lower than £500,000. So I'm going to show you how to record that. So in 2019, which is the new accounting year, the value of my building and land will change. Statement of financial position for year 2019. The value of land will be £400,000. The value of my building will be £450,000. £450,000. And what will be the depreciation? 31st of December 2019. The depreciation charge for this new year, which is 2019, will be calculated. Less accumulated depreciation. We will take the value of the building, £450,000, divided by the remaining life of the asset. Now remember, the original life of the asset was 40 years. 40 years. Out of 40 years, 10 years have passed, so the remaining life is 30 years. And the depreciation charge for 2019, just for 2019, will be £15,000. So the carrying value of the asset is 435,000. £435,000 is the carrying value of our building. Which is also a net book value. Carrying value, net book value is the same thing. Income statement. In my income statement, I will be recording a depreciation expense of £15,000. The total revaluation, you can see from this diagram, the total revaluation in this question is £400,000 for the land and £75,000 for the building. So let's record for the land first. The double entry for the revaluation of the land will be the value of land will be debit by £100,000 and the revaluation of the land will be credited by £100,000. The next part is the building. The value of the building has also gone up compared to its net book value from 375. You can see from 375 it has gone up to 450, and the revaluation gain is £75,000. So the revaluation will be £75,000. £75,000, and whenever the asset is revalued, the previous depreciation is all erased. So previously, from January 2009 until 31st of December 2018, the depreciation, accumulated depreciation for 10 years was £125,000. So we need to debit the accumulated depreciation of the building by £125,000. What needs to be credited? The value of the building will be credited by £50,000. Now, this is also the balancing figure in the double entry. In the double entry, the debit side should always be equal to the credit side. So the debit side is 125,000 and the credit side is appearing as 75,000. So the difference is £50,000. So let's see if it is true. If I draw a T account of the building, originally when I bought this property, the value of the land was 500,000. I will record it on the debit side. And looking at this double entry above, building is credited to £50,000. If I close this account, the heavier side is the debit side, £500,000. Copy the same on the other side, £500,000. And the difference between 500,000 and 50 is £450,000. Carried down balance. And this will be the brought down balance, the opening balance for the next period, £450,000. So you can see the value of my asset has gone down from 500 to 450. And this is the revalued amount, 450. You can see 450 is the revalued amount. Thank you very much. I hope that you'll find it useful.